Thanks for stopping by. It's Margaret Heaster's The Mortgage Chick. Today's going to be a really quick video and basically an overview of the 3 kinds of prepayment penalties you could be looking at should you break your mortgage early. Now, most people, when they get a mortgage, they go into a 5-year fixed rate mortgage because they want to know exactly what their mortgage payments are going to be for 5 years so they can budget. We also know that most people don't stay in that mortgage for 5 years. The average is 3.5 years. So like in a previous video, I talked about having really honest conversations with your mortgage broker. You want a broker that's going to ask you what your long and short-term goals are. And this video is going to give you one of the examples exactly why that's important. Let's talk about a really low rate mortgage. Everybody thinks that they want the best rate, but it's not always the best deal for you. For example, there are mortgages out there that are called a low rate or a no frills, and they're extremely low rates. Now, when you're in a mortgage like that, a couple of things can happen. You're either locked tight into that mortgage where you cannot get out of that mortgage unless you sell your house. So you need a mortgage broker that's going to explain that to you before you sign the paperwork. The second thing is it's going to be a simple interest penalty payment. And what I mean by that is you're going to be charged 3% of the balance of your mortgage, no matter how long you've been in it. For example, if you've got a $300,000 mortgage, you want to get out of that mortgage for whatever reason. If you want to refinance, if you want to just switch to another lender that has a lower rate, like I said, $300,000 mortgage, it'll be a $9,000 penalty. Not cheap. You think it's a good deal going in, it's not a good deal going out. Anyway, the next one is a 3-month interest penalty. And you generally get that when you're in a variable rate mortgage. It's quite simple. You're in a variable rate mortgage for 5 years. You want to get out after 3 years. You figure out how much of your mortgage payment is interest, triple that, and that's your prepayment penalty. That's what it's going to cost you to get out. And you know what? That makes sense if you're not sure if you're going to be in that mortgage for 2 years or 3 years or 5 years. If you're not certain, if you're steady Eddie and you know you're going to be there, stay there for 5 years, be in a fixed rate mortgage, all is good. The next penalty scenario is interesting. This is called an interest rate differential. And now before I get into that, it's interesting that every lender is required to tell you what kind of penalty you're going to incur if you break your contract. They're not required to explain how that is calculated. Now, an interest rate differential penalty is really difficult to explain and it's impossible to predict. So to simplify things, what you're going to be looking at for an interest rate differential penalty is the interest rate that you're paying now, which is on your contract, compared to probably a lower interest rate today, times the number of months left over on your mortgage contract. So if you've got a 5-year fixed term, you want to get out after 3 years, you got 24 months, the interest between your contract rate and the lower rate, if that's the case. Now, it's kind of interesting because the big banks, as you know, when you walk in the front door, they have a posted rate for the mortgage. It's generally quite high. And you know and I know that you can walk into that branch, you can negotiate a lower rate. Everybody does, everybody knows that. But the interesting thing is, if you want to get out of that contract, the way the big banks calculate their interest rate differential is they take the posted rate compared to today's rate. So not the rate that's on your contract, not the interest rate that you're actually paying, but the posted rate that you saw when you walked into the branch. So that prepayment penalty is going to be quite high. Now, there are also monoline lenders. A monoline lender is a lender that works specifically with mortgage brokers. They don't have a posted rate. You've got your contract rate or the rate that you're paying now. If you want to get out of that mortgage, they're going to calculate what your contract rate is or the rate that you're currently paying, as opposed to today's probably lower rate. Multiply that by the number of months, and there's your prepayment penalty. Generally, it's a lot less money. Now, if this is something that you're really interested in, like kind of delving into and getting more information on, comment down below. Let me know, hey, Margaret, I want to know the numbers. Show me the real numbers. I can do that for you. If there's enough interest, I will take a mortgage and I will do 3 comparisons for you, or 4 comparisons for you, just so you know. I hope you like this video. I know it was short and sweet. If you did like it, give me a thumbs up, comment down below, and subscribe to my channel. When you subscribe, ring the bell, and it'll let you know when the next video is coming up, because you don't want to miss anything. See you in the next video.